Now, this is one of the places where futures trading started over 150 years ago, the Chicago Board of Trade. And there's me actually inside the CBOT on the trading floor. Those more familiar with futures trading will recognise these pictures and noises, the hubbub, the aggression, the great intensity of the futures trading pits. But as you know, times have changed, and that's given us new opportunities for today's trader to access these markets. So why would you want to be trading futures? We are going to cover off all of these in a lot more detail in the video, but running through them briefly. Firstly, new strategies. It's going to give you a whole new outlook on trading. For example, spread trading. Secondly, you can go long and short the market, so we can take advantage of whatever direction, bullish, bearish, is before us. We can get something called margin and leverage trading, so we can get more bang for our buck that we are using. We get access to a whole load of new markets like commodities, interest rates, all sorts of markets, like I say there. Fifth, risk management, a great tool for risk management. You learn what hedging is. Very good for automation as well. There at number 6, very good if you're a programmer, easy to create some very effective automated strategies there. And finally, number 7, very good for creating market analysis tools around the information that is out there on futures trading, which again we will see and explain in more detail soon. So very briefly, what will we be covering in this course? Well, how the futures work, who uses them, the terminology, the history, the science behind them, how they can benefit your trading investing, where you can access and trade these futures markets from anywhere in the world, trading strategy ideas, some secret analysis tools for you there thrown in. So loads and loads to cover in not a lot of time, but let's start with a bit of history. So we've got to start with a bit of history, and in particular American history, and we need to do that to get a full understanding of how the futures market and trading has developed, and it's critical for your understanding of how it now works. Now, if we take ourselves back into the 1800s, the US was predominantly a East Coast focused country, and then for many reasons they pushed west towards the Pacific, and in between that a lot of pioneers found grains, mining, cattle, all sorts of commodities that could expand the growth of the US economy, feed the US economy and population as it grew and developed. Now, think about this logically. If you have a commodity, let's take corn for example, you've got to get it from the, maybe the fields of Kansas to maybe an end user in New York or Chicago, somewhere else that wants to turn that into cereal or whatever. But how does the person from New York say know what they're actually getting, the quality, the size, the standard, all those variables before it comes to delivery? What day is it going to get delivered on? There's so many different variables, and in those days it was very difficult to manage that process. So it needs standardizing, and this is where exchanges came in from New York and in particular Chicago, and they created a concept that put those buyers and sellers together, and that helped alleviate the risks from both points of view. The seller knew what they were getting from the buyer and vice versa. And as you can tell, this was heavily commodities driven to start with, and as the US economy grew, so did those futures markets, and famous exchanges like the Chicago Board of Trade really flourished and pushed on. And then we bring ourselves into the 20th century as financial markets really took off. Financial institutions, the exchanges, trading companies realised that you could add more futures markets on different types of product, maybe financial products, financial markets like the S&P 500, stock markets, the FTSE 100 over in Europe. The 20th century really saw a takeoff of futures trading around the globe. Forex, bonds, interest rates, all of these products can now contain futures contracts. And in the last 5 to 10 years, we've seen a massive growth in cryptocurrency futures. So you can see now the market for futures trading, which initially started in the world of commodities, now encapsulates so many different markets and gives us as traders some great opportunity to create really highly effective, profitable strategies around those markets. So like I say, very important to understand the history of the markets, because it will help you understand how these futures work and trade at the moment, their peculiarities, the detail that you need to know. So that nicely brings us on to getting into understanding what futures are, how to use them, where to get hold of them, and all the other stuff you need to know. First thing we need to know is that a futures contract is a derivative of some underlying asset. Like we've seen, it might be corn, it might be oil, it can now be crypto or the S&P 500. So as it says there, derivatives contract is an instrument whose price depends on or is derived from the price of another asset. So we know it derives from another asset, but what exactly is a futures contract? It is quite straightforward, really. It's a contract, basically, a financial contract obligating the buyer to purchase an asset or the seller to sell an asset, like we say, a physical commodity, a financial instrument, at, and this is an important bit, a predetermined future date and price. And those contracts will also detail stuff like quality, quantity of that underlying asset. They're standardized to facilitate trading on futures exchanges like the CME or ICE. Forwards, you might have heard of them as well. They're the same as futures, but not exchange traded. Got a couple of examples to show you of what a modern spec of a futures contract looks like. This is from the CME exchange, and first up we have corn. Notice its units of 5,000 bushels. It's priced in US cents per bushel. You can see the trading times, the minimum prices, the contracts that you can trade in terms of futures settlement period, a method saying it's actually a deliverable type of futures contract. So a lot of information. There's more information there on the contract. And our second example from the CME is for copper, and notice this one's quoted in pounds. So it's 25,000 pounds of copper for one contract. You can see it's pricing, the futures, minimum price movements, contracts, the whole lot. It's all in there. If you want to investigate further on these sort of things, have a look at www.cme.com. Now, a key term here, physical delivery. Now, that means if you left that futures contract to expiry, you might get delivered whatever you have been trading. So it could be oil, soybeans, corn, rubber, whatever it is. And you probably don't want that to happen unless you're an end user, like a factory plant, manufacturer, that sort of thing. The other flip side of it is some are cash, financial settled, so there's actually no physical delivery involved. So something to watch out for there. And some other sort of fun futures facts before we get into the detail of them. Futures contracts use high leverage relative to, say, stock markets, and initially they were really used as a hedging product. And what does hedging mean? Well, that's down the bottom there in red, a trade strategy designed to reduce risk. Or the other flip side is futures are used to speculate on price movement. So two options for us there for usage of futures, which we'll look into in a lot more detail as we progress through the video. You might have already picked up that these standardized contracts need to be, controlled, monitored, facilitated from some fixed location, and that is done through what we call the exchange. And historically they've been regional to the markets that they are involved in, for example in Chicago and New York, but they're all over the globe as well, London, Paris. What you are probably familiar with is seeing all those guys shouting at each other. That's futures trading, and they're called trading pits, where they're basically putting buy and sell orders together to facilitate the flow of whatever market they're getting involved with. The pits unfortunately are fading out, and most have become computerized, and the world of futures trading is pretty much dominated by two US owned exchanges, one called the CME and the other ICE. In the last 10 to 20 years both of them have been hoovering up, sucking up other minor smaller exchanges, and for example CME has bought COMEX, which is metals, CBOT, NYMEX, which was like your oil. ICE has bought IPE, NIBOT, WCE, TSX, Canadian One, the New York Stock Exchange, Euronext. So, quite a lot of consolidation in the futures world. And the other big growth market at the moment is out in China. They've got quite a few futures exchanges, but the Shanghai Futures Exchange is probably one of the biggest ones that you might want to get familiar with, but very difficult to access and trade through. So a brief look at the CME and what products it can offer. Their website is well worth a visit if you want to learn more about futures, but as we can see here, just a really quick overview of the sort of markets they offer. You can see a list of major popular ones down there on the left: corn, soybeans, crude oil, S&P 500, but you can also see the sectors, areas that are involved with agriculture, energy, equity indices, FX, interest rates, metals, options, a whole host of futures markets that you can trade. And their main competitor, the ICE exchange, what do they offer in terms of markets to trade? Again, a lot of choice, credit default swaps, metals, indices, interest rates, energy, and I just clicked on agriculture there so you can see the sort of markets you've got there: canola, cocoa, coffee, cotton, sugar. It really does give you an exposure to markets you can't really normally get your hands on. So now let's step through a simple example of how a futures trade gets put together. Now we've got an example using a metal, and that metal is copper. Now it used to be traded on the COMEX before the CME bought them up, and in this example trader A wants to buy 1,000 lots of copper from the COMEX, and he wants it for his company's infrastructure product and wants the copper delivered. Now one lot, as we know, equals £25,000, and the current price is 2.7855. Now he goes to the COMEX exchange floor, and at the same time trader B wants to sell one lot of copper. Now he's a speculator and he thinks the price is going down, so he's quite happy to sell. So he also goes to that COMEX exchange floor, and it's the COMEX that puts the buyer and the seller together. Now trader A and trader B have been put together under the contract through the COMEX for this copper trade. Now eventually they'll want to close out the trade. We know that trader A wants to keep it through to expiry to get the actual physical metal, whereas B wants to close out just because he's more interested in the price movement. Now if it has gone down, he's made money and he's happy, and the details of the delivery will be in the details of the contract published by the exchange. Now do note that trader B is not obliged to deliver the metal. He's just the other side of the contract. He can close out any time and someone else will take his place. It's that job of the exchange to keep that whole process in balance. And that brings up an important point about market size. Some commodities are very small and don't have a lot of volume and interaction, buyers and sellers. So if you're holding something and there's no one to sell it to, then you might have to wait a bit of time to get your order filled, and the price might slip accordingly. on how desperate you might be to get out of that position. So that's always worth bearing in mind when you are trading futures. But most, though, are of a decent size where orders get fulfilled very quickly. Futures markets and trading does have a language all of its own, and I'm going to take you through some of the key bits of terminology in that area. Now, first up, contract size. I think you can guess what it probably means. In our copper example here, one contract equaled £25,000 of high grade copper. If it was corn, for example, it would be that 5,000 bushels that we saw earlier as well. The underlying asset, what does that mean? Well, we've worked out that futures are a derivative product, so it's the underlying asset. It could be copper, it could be oil, it could be a stock market, but that information that's key to the contract, the quality, grade, weight, size, delivery, dates, trading hours, all those sort of things are all included in the contract. Next up, delivery. What does it mean? Well, remember, most contracts do not get delivered on and are closed out prior to expiry, maturity, and all the delivery arrangements are specified in the contract. Remember, some users, the commercial users, might want actual delivery of that underlying. And very importantly, all these futures contracts have contract dates, and it's normally done by a month and a year, and the exchange must state the precise period when delivery can be made. In this example, HGZ8 quite simply means at the time of putting this together that it's for delivery December 2018. Is that confusing? It is to beginners, but I've put together the code cheat sheet list for you. So each month has its own letter. Now, an example, corn June 2026. How would that read? Well, corn has its own ticker called C, and then we need a space, and actually that should read M because June is M, not N. That's July. It should be C space M6, and that would tell you that it's corn June 2026 expiry. The futures exchange will also say when the contract you're looking at begins, as well as its last trading day, which is normally a few days before delivery. Two other points that most people aren't aware of: the exchanges are monitoring and have price movement limits and position limits on those contracts, so often they can affect how they are traded, so be aware of them. Mostly in commodities and mostly set up for risk and safety purposes and the protection of those markets. Some more terminology. Remember, the flip side of physical settlement, then a lot or some of the futures contracts are only settled in cash, and that's due to the convenience and the impossibility of delivery. For example, the S&P 500, how would you ever deliver 500 stocks or the indices like that? And then a couple based around liquidity and volume. Remember, we talked about maybe slippage and how you want to get out of a futures trade might be difficult depending on the market that you're trading. Now, there's some data available for you, and that's open interest, the total number of contracts outstanding on any instrument, the sum of all the long positions, and also volume, that's the number of contracts traded. Now, they're readily available on the exchange, and as you'll see, certain contracts on certain products are more popular than others for various reasons that we'll look into. Let's go back to our copper example to explain one of the most fantastic things about futures trading, and also one of the most dangerous, is that of leverage. Now remember, our one contract of copper, if the price was $2.78, we times that by £25,000 and the value of that contract is $69,375. That is rather expensive for almost everyone. So what the exchange let you do is trade on something called margin. Now imagine that as a security deposit against the full value of the one contract of copper. So we're going to be paying part of percentage, a small amount of that as margin to give us access into that one lot of copper. So for argument's sake, let's say that margin was 3,100. Now if we divided that into the value of the one contract, which is $69,375, that gives us a ratio of 22.4 to 1. Now that ratio is known as the leverage, because we've only had to put up 3,100 to access the full amount of that contract, and the profit and loss is based around that full amount. So we're actually getting 22.4 times the amount, that we've put up as exposure. So that can seriously magnify our profits. But on the downside, which I said why they're so dangerous, is it also magnifies the downside and the potential losses that you could accrue. Now the official terminology for that 3,100 deposit is known as initial margin, and it's going to give you, like it says, the ability to trade many multiples the size of your account. Now you're going to have that initial margin in your account to be able to access that one contract, otherwise you're not going to be able to trade it. But also on top of that, there's something called maintenance margin, and that's where the exchange sort of basically have you keep a top-up fund if the prices move against you, that can always keep that initial margin balance healthy and your account healthy, so if there is any adverse moves you are well covered. And if you don't top it up, the exchange, the broker that you're dealing through, can terminate that position immediately. You'll get something called a margin call. You'll get warned. You have the chance to correct it. If you don't, like I say, you get closed out. Now I just want to reiterate a couple of those points again, because they are important. Right, to open that futures position, you will need in your account a value of the initial margin, and that maintenance margin is the minimum amount that must be maintained at any given time in your account. Remember, if it goes below the level, you're going to get that margin call, and you're going to be required to add those funds in immediately to bring the account back up to the initial margin level. Like I said, very important to know and understand when you are trading futures. Now you're probably thinking $3,100, that's a bit toppy to open just one lot of copper futures. Well, the exchanges have thought of that. Now that 3,100 on that one lot was a standard lot. That's the traditional largest lot size and covers all markets. But like I say, the exchanges have thought about this, and they've created smaller versions to give access to all. Now the mini lots are a fraction of the size of the standard lot, and the micro lot is a fraction of the size of the mini lot. So one standard lot equals 10 mini lots equals 100 micro lots, to give you an idea. And as you will see later, they are available on a lot of these markets, especially the more popular ones. But a fraction, that 3,100 suddenly maybe becomes $500 or $600 or even less. It becomes more attractive and possible to trade. Now if the leverage concept wasn't good enough, then the futures contracts are giving us even more. Now it all comes around the contract structure. What do I mean by that? So our example here, WTI crude oil, we can trade the spot price. Now that is the price right now today, but a futures contract is going to allow us to buy and sell contracts of WTI based around its futures price. Now there's a mathematical formula for coming up with that price. We're not going to go into it in this course. It is quite straightforward though, and that creates a whole string of futures contracts to trade going out many years in the future, and that string is very rarely linear, and it's often in a more wavy line. But the real basis behind the sort of structure of that line is really based around supply and demand relative to that contract. Now I've been calling it a wavy line, but it's actually called a curve. And when you become an expert in futures trading and have got an account that will give you access to that full curve. Then there's something called spread strategies that are available to you, not available in other markets, where you can play parts of that curve off against one another. So here's an example of WTI, that curve from one of the brokers I use, and we're going to look into them later on. But you can see how many different months are available to trade, but also notice the different prices that each of those contracts has relative to each other. Let's get the terminology right then for this, new type of idea concept that futures has thrown up. We've got the physical spot markets, that's the price today now, and then we've got the futures market, that other part of the curve where you're trading the future price now. So some interesting points there, and we can see the price today is higher or lower than that of its future price, and that's all really down to supply and demand. And if you saw the price was higher in the future today, you'd expect that the market believes there's some sort of supply or demand imbalance that is impacting that price. So actually that future curve can give you a lot of information about what's going on. So let's get the terminology around this part sorted. We now know that a curve is a series of price points, future price points, joined together starting from the spot price into the future to create that price line, and we know that as the curve. Now contango, now that's if the spot price today is lower than the futures price today, and the market is then said to be in contango, and vice versa. Backwardation, if the spot market is higher than the futures market today, then it's said to be in backwardation. Now this is a graphical representation of contango. We can see that the spot price today is low, down around 40, I think it says there, and we can see that the price going forwards into those future months is a lot higher, and that is our curve, those price points joined together. And because the spot price is less than the future price, we call that market in contango. Now the flip side to that is backwardation. Look where the spot price is relative to the futures price going forwards. We can see the spot price today is 100, and in half a year's time it's down sort of the 50 area, and because the spot price is greater than the future price, it is called a backwardated market. Futures are the gift that keep on giving. We've got leverage, we've got this curve to give us extra markets and time periods to play. Now we've got something called going long or short. Now traditional market, we buy something and we want the price to go up. Now futures markets allow you to do the opposite. You can actually sell before you buy, and you might have, for example, a bearish opinion, and in here we got soybeans we think are going to fall heavily due to a bumper crop. What do? Well, you sell the futures contract first and buy it back later at a lower price from that of what you originally sold it at. And how does that work? Well, for now you need to know that the exchange facilitates this long and short mechanism, as does your broker. And just to help you out, I've tied it in with a couple of other bits of terminology, bullish and bearish. If you don't know, bullish means any market going up, and bearish means any market going down. So you see that bear chart there, bear market chart. Notice how the price is, the arrow is pointing downwards. That's the sort of price we want to see happening, and vice versa for the bull market. And then notice how we tie that bullish bearish concept in with going long and short. Notice going short is bearish, going long is bullish. Now bullish, going long, we buy at say 60 and sell maybe 2 or 3 weeks later at 100 and make 40 profit. Going short, we sell first at 100, we think it's going to go down over the next few weeks, gets to 60, we buy it back at 60 in the future, and we've also made 40. So that is the beauty of futures trading. It allows you 50% more chance of trading opportunities, because we can now instigate a point of view where we can go shorter market and take advantage of falling prices. So hopefully you're getting keen to trade futures markets now. But what markets are available to trade? Well, we've got something called stock index futures. That's like the stock market, like the S&P 500, the Nasdaq 100 in Japan, the Nikkei 225, FTSE 100 if you're in the UK, DAX if you're from Germany. They're normally cash settled. We've got currency futures, so we can even do it on Forex pairs like US dollar against the Japanese yen, the pound against the dollar, the Australian dollar against the US dollar. A whole bunch of combinations available there. Lot of commodities out there: meats, grains, metals, energies, softs, all available, and other areas, other markets as well, bonds, interest rates, and as I mentioned previously, a very big growing market is that of crypto futures. So who's policing all of these futures markets? Well, in the US it's governed by the CFTC. Now, most likely that you'll be trading US based futures, so that means you'll come under their jurisdiction, and they are the rule keepers, the analyzers, the regulators, the police of the futures market. Calculating profit and loss on a futures trade can often cause confusion, so I've just put our copper example down here. Remember trader A, where he bought that one contract at 2.7855. The minimum price incremental move there on copper, by the way, is 0.0005. So one contract was worth £25,000. That's contract units times the price gives us the value of that contract, 69,637.5. Now let's say the price went up to 3.155 over the next 3 weeks. How much has the trader made? So if we go through that same mathematical process again, the value of the contract is now worth 78,875. We take the two away from each other, means $9,237 profit. But remember, you only put down $3,100 of margin on that trade. You never paid the full amount of the contract. So that's a pretty decent return on a 3,100 deposit, nearly 3 times the amount. So that's the beauty of margin and leverage. Now, if you want to keep hold of your position, remember there's the expiry day of the contract. You can roll your position to the next futures contract. There's a small cost to that as you flip between the two, but that can keep your position going if you want to keep rolling it along that curve. We know that there's 2 ways to use futures. That's of price speculation, either being long or short, or risk mitigation, hedging, neutralizing the risk to the underlying asset. Now we're going to look at 2 examples of hedging because both of them are very important for the understanding of how the market actually works. So our first example is around a corn farmer, farmer A, and he thinks prices of his corn are going to collapse from where they are today in the future, and it's a concern for him because it's going to go lower than what it cost him to farm the corn out of the ground. So he needs to protect his business and livelihood. What's he going to do? He's going to go short futures contracts against the corn he holds. So how does that play out? So we've got a graphicalized example here, a short hedge. Now, corn costs farmer A $3.50 to produce, and that is what it is currently trading at in February. Now, he has to get his corn to the market in August, so a few months away, but he thinks, like we said, there's going to be a massive oversupply and the prices are going to fall heavily. So let's work out what he needs to do. So he sells nearby futures to lock in his prices, and lo and behold, his analysis is right. The price comes off 100 by August delivery to 250. Now, if he didn't hedge his risk, his actual corn would have lost him 100. That's 350 minus 250 to the current price. But if at that initial outset he went and put on that short futures position, he sold it at 350, and then in that future collapse in the price down to 250, he would have made 100, and the 100 loss from the corn position and the 100 profit from the futures position net out to 0. He's a happy guy because he's basically lost nothing. He knows the price he's locking into for his business. He gets the price that he wants at market. So that is an example of hedging the risk out of your business. Our second example is based around oil price. Now, Mr. X owns an airline and he's worried about the rapidly rising oil prices because that's going to eat into the cost of his ticket sales. And he had a right to be worried as the oil price went up from $30 to $80 very quickly, which could have put him out of business. But luckily for him, he bought some futures contracts when he had his first suspicion the market was going to rise. But how did that one play out? So we know that Mr. X bought those nearby futures to lock in his prices, and if he didn't hedge, the oil position went from $30 to $80. That's $50 more expense that he has to factor into that ticket price, and his airline probably goes bust. But if he hedged the position, remember he bought the futures, he would have lost $50 on the price rise of the actual oil, but the underlying, when he's buying that futures, the derivative contract, that went up from 30 to 80. So he's actually made $50 of profit there. So negates that, real fast rise in the price, and therefore net zero. And he's a happy customer because he's still back in business. Now, they were two very obvious examples of risk management, keeping the risks neutral for business purposes. Now, what most of us are interested in, making money around the price movement, and that's called speculation. So let's go back to Mr. X again. We know he hedged out, but what if a trader at a large bank had the same idea as Mr. X, wasn't tied into the underlying, and he bought the futures just as a futures contract? Well, he would have made that same $50 gain, but it wasn't offset against anything. That's pure profit. Now, this is the art of speculation, using futures to capture that outright price move either to the up or downside. So we've mentioned it a couple of times before already, but let's introduce you now properly to a particular strategy used in futures world. That's called the spread trade, and it's putting different parts of the curve together. Now, we're an oil trader again, and we think the price of oil now is going to go down due to oversupply, but you also believe that due to maybe potential large-scale production cuts, the price of the oil in the future is going to fall heavily. The futures curve currently is in backwardation, so what do we do as that trader to make some money? So if we were trading this, we would look at the structure of that price curve, and we would find the price now and maybe the price in that year's time or 6 months time, whenever we think that price is going to fall. And if we just also dive into the specs, from the specs we can clearly see the inputs to our contract. We can see one contract's 1,000 barrels. We can see the currency, we can see the expiry dates, how much margin we need. If we're long, it's over $11,000, so check those as well. Again, this is a very obviously created example. So what do we do? Right, around our point of view, we sell the front month now futures and we buy the futures contract. In this example, we're going for a year out, so the prices of both November 2022 is 89.53, the negative signs there because we're selling, and 76.97 for November 23, positive sign there because we are buying. Now in 2 weeks time, the prices have gone down at the front to 84.53 and up $10 to 86.97 for the November 23 contract. What does that mean in terms of profits made? Well, on that front contract, we'd have made $5,000 profit on closing out when that price moved happened, and on the back contract, that one a year out, that $10 move created $10,000 profit. So by combining our point of view on the curve, we made 15k of profit. So that's just a really obvious example. It's a bit more complex than that because all different points of those curves can move in any direction, and it doesn't always work out that both sides win. You might be neutralizing one side to gain the other, etc, etc. But that's just to give you a perspective of how the spread strategy works in futures world. So we're now looking at something called commitment of traders. It's all around sentiment of the direction that certain traders and users of these futures are going in. So wouldn't it be great if you knew which way they were going to move, and whether these professional traders are either long or short, or the groups, the users like the commercial ones we saw in our example, the farmer, the oil airline guy, they need to be right to keep their business going. So we can rely on this sort of data for getting an idea of the direction of the market that we're looking at. Now, even better still, the CFTC every Friday publish a very detailed set of stats around all of these groups and whether they are long or short. So we're really interested, for the purposes of our education here, for two groups. One we call the commercials and one we call the large speculators. I've already mentioned them. Large speculators are the investment banks, hedge funds, trading companies, those guys that call the direction right, and the commercials, those users, the professional users of these markets. So a bit more detail on those two. Commercials, like I said, they're the end users of the commodity market. They're people wanting to protect themselves from adverse price moves. So if they are long, say corn, you'd expect them to be short the futures contract. So they've got an inverse futures position to the actual price. So if we see the futures market going short for the commercials, then we could expect that the price of that asset that they're looking at is going to be going up. And for the large speculators, like we said, it's the hedge funds, the investment banks, those type of people. Now it's their job to guess the correct direction of the market. If they don't, they get the sack, they move on. So we're expecting a lot of the time for them to be right in the direction that the market is going. So if we see, say, corn going up in price, and we can also see that the large speculators are also long in the CFTC reports, then we can assume that the market is going up. Now, where do we get hold of this information? Well, you can find it on TradingView, which is a charting package. If you're a programmer, you can go straight to the CFT website. It's all free, the information. You can build your own COT tool. There are other vendors offering this type of analysis out there, but let's have a look at a few examples. So our first example, I think it's corn, could be wheat, doesn't really matter here. Notice the price there in the middle going up and down. That blue line is the large speculators. Notice how it follows the price in the same direction. But the green line, that's the large commercials. Notice how it does the inverse of the corn wheat price, and that red line in the middle, they're the small speculators. We ignore them because more often than not they are wrong, but just notice the correlation between the blue and the green lines and the actual price. I think you would agree that this sort of information is very useful for your trading. Many different ways of using the COT data, changes in size of position, crossovers of, say, the large specs and the commercials, extreme overbought, oversold zones, raw numbers, etc. There's different ways of manipulating and changing the data. An example here, values over 90 are considered overbought and looking for a trend reversal, and minus or less than 20 oversold and looking for a trend reversal there. And as I said there, add in other indicators of technical analysis, and it really strengthens this sentiment tool, the COT data, when you're adding in as an independent variable to your trading analysis. So here's an example of how you could set something up. It's corn again. We've got the price at the top, blue line, the large speculators. Notice how the price is going up and down in line with the price, but below that, couple of technical analysis indicators, stochastic at the bottom, in the middle there, that I've stripped out, and we would look for crosses and up through the 20 line and down through the 80s for possible entry signals. So once you start combining other tools with this data, it can be a very good, either action to get you in or out of trade, or use as like a trend filter tool. So just another example, using WTI crude oil, you can see the large commercials and the large speculators doing what they should be doing in regards to the current price. And maybe, you can just, like I say, use this as a trend filter to go in the direction of the market flow. Why, fight what these professionals know that you don't? So how do futures traders come up with their ideas and strategies? Well, they use fundamental analysis, technical analysis, behavioural analysis, quantitative analysis, maybe all of them, a blend of them, one of them, completely down to them. Another thing that's very popular in the futures world is algorithmic trading. That's automated trading. And I think if you're getting started in futures trading, the easiest way to get going is by using technical analysis. What about styles of trading? What does futures trading suit? Well, actually all of it really. Scalping, swing trading, trend trading, day trading, you name it, it works in it. Same for the markets. All the ones we've looked at works very nicely, and the same for time frames. You can use them really on any from seconds all the way through to weeks. And other things to note that most of these contracts are in US dollar, so there's the dollar effect there. And also another good point is that due to electronic trading now, most of these markets work 24/5. Now, if you want to learn all about technical analysis or how to become a trader through the whole spectrum of variables that you need to master, from psychology, trading plans, risk trade management, strategy design, technical analysis, all those different inputs, then I've put together a couple of playlists that you might find interesting on my YouTube channel, TheStopHunter. We've got the big one, the ultimate free trading course. If you started from top and worked your way all the way down to the bottom, then I think you're going to be in a pretty good place to start trading. Covers everything. But if you just want to get into technical analysis, there's another playlist built just around learning all the different aspects of technical analysis. Definitely worth your time if you want to grow as a trader going through those two. Let's get down to the nitty-gritty of where and how you can trade these futures contracts. Now, you join me in my broker. They're called Tiger Brokers. I'll put a link in the description below this video for you to follow if you want to check them out further. And if you go up to the market tab on the left, you can see all the different markets you can trade, and there's futures sitting there. And if you lit the all futures button there, you can see how many different contracts they've got, and they've got, if we scroll right, 118 different futures contracts you can trade, and we can go through all them individually by their different sectors. We've got equity indices. Have a look at all those, pretty good global coverage there. We've got energy products. Now remember what I said about the different sizes for different budgets. We got the main contract, then we got the mini and the micro. We've got precious metals, and notice we got some Chinese futures there as well available. Foreign exchange, forex, good selection. And interest rates, if you're into those. Agricultural products, oats, soybeans, wheat, rice, hogs, all there. Metals, copper, very good one. We've got the mini copper and a micro copper as well. Iron ore even, and even some equities. And you notice there Chinese stock futures, Tencent, Xiaomi, Ping An, Alibaba, all there. So let's just take a quick look at one in particular. Let's go to one of my favorites, crude oil. You click on there, and then it's going to bring back that chain of different contracts you can trade. And remember what we talked about, putting together spread trades and strategies like that. Well, you can see actually we go out into 2024 here, so you've got some good spreads that you could put together. But what you're looking for here is the main one. It's got the main 2211. That's the front month futures contract. That's the important one. And if you scroll across, you can see all the volume is in there. That's actually November. You can see because the two are replicated there. If you just want the outright, exposure at the front end of that curve that we looked at, then that's the one for you. CL main would be the ticker there, but you can pick off any of these and you can see the volume that we've got by each contract. And if we just scroll across as well, you can find other data like open interest as well. You can see all the open interest is in these contracts here, and like I say, it provides you a lot of information. So let's just click into the main one. So we double click there, brings up the contract. You can see where you can buy and sell it here on the right hand side. Very easy, just simple buttons to press. And if you want to find out about the contract, click on it and it's going to give you a summary of the units, expiries, margins, all that type of information you need. And there's a lot of stuff going on here in the Tiger Brokers site. Got news, analysis, research, calendar events, all sorts of things. But as you can see, again, just to remind you, you go to market, you go to futures, and like I say, you've got a great selection, over 100 futures markets to trade, and then multiply that by all the different time periods, expiries that are off of those individual ones. Then you've got countless strategies and ideas and markets that you can put together. So Tiger Brokers, why I like these guys is because you can access these from anywhere in the world, fully regulated, nice, easy to use system. It's mobile friendly, and like I say, where before it was quite tricky to get into the world of futures trading, this is very straightforward platform, and as you can see, gives you a way in very easily. So here's the question: how much is it going to cost you to trade futures? What do I mean by that? How much do you need to have in your account to start trading futures? We've looked at initial maintenance margin, so we understand that we need a bit of cash in the bank to be able to do this sort of stuff. Now also remember about the standard lots, the mini and the micro lots, which allow you, those smaller ones, a cheaper access into the world of futures trading. Now inside the broker here, Tiger Brokers, we've got crude oil, and if we hit the contract button, we can see down the bottom there the initial margin we need. Now for this contract we're going to need over $11,000. That's quite expensive, but if we go back to the other WTI contracts, let's have a look at the E-mini, see what that has. We just find the main one and again pull back the contract information, and we can see the mini we're going to need just over $5,000, so a big chunk less than the standard lot. And then if we go to the micro, again same process, energy, micro, find the main one again, there it is, click on that, go to contract, and there you can see actually to trade one lot of micro we only need just over $1,000. So you can see it becomes a lot more affordable for futures trading if you use the micro lots and the mini lots. And some people just trade one lot, though. They just like to trade one lot of futures, and that's their strategy until they build up the funds to move up or add further lots into the mix. And let's just have a look at some other markets that offer this sort of stuff. Another popular area is equity indices, and you can see here we got E-mini S&Ps, we got a micro E-mini Russell. Let's see if we can find some of the micros. We've got micro DAX, micro Euro stocks, so we've got a good mix there. So let's just have a look at the micro E-mini, see how much that will cost us to play with. Same process, and it's $1,100. So the answer to that question is, if you want to get started trading, I reckon if you've got $2,000 in your account for futures trading, then that will be a sufficient starting amount to get you going. Now I'm hoping that I've given you all you need to know to get started futures trading, and if you've liked the video, you know what to do. Hit that like and subs button. Now I also mentioned in the video that if you're new to trading, you want to learn how to build out trading, learn that fundamental technical analysis, the risk management, the psychology of trading, all those things, how you build your own strategies, then I've put together a playlist on the YouTube channel that if you start from the top and work your way through, hopefully will get you up and running successfully as a trader. And here it comes now.